this isn't just volatility in my mind. It's the market exposing the shortages of physical silver, the frailty of the paper promises. This is something that I think is just beginning. And there's just far more demand for physical silver. People have accepted paper promises for a very long time. And I think that's coming to an end. And look, this is decisively bullish for silver and other precious metals. If confidence in this paper system collapses, like we're seeing, a structural reset could start to reprice silver. That's what I'm seeing. And no one acknowledges it. Everyone says, oh, it's FOMO or it's going to crash. But what if it's part of a bigger plan? And the central banks understand this. This is why they have been taking positions in gold and silver the way that they have. I think this is just the very beginning. So yes, you're going to see pullbacks. You will see volatility. Nothing goes straight up. But I would agree with you that ultimately it is a buying opportunity.
The silver market is reaching a breaking point. What began as volatility has now revealed a deep structural problem, a global shortage of deliverable physical silver. Behind the headlines and short-term price swings, there's a clear shift taking place. The paper-based system that has dominated the silver market for decades is beginning to fracture under real-world demand. For years, massive paper contracts have been traded on minimal underlying inventory. Now, as more buyers insist on physical delivery, that leverage is unraveling. When futures trade below spot and lease rates skyrocket past 30%, it's no longer speculation. It's a signal of genuine stress in the global silver supply chain. AndySchectman, a veteran precious metals expert and CEO of Miles Franklin, explains that this imbalance could mark the beginning of a historic repricing event. As the paper promises fail to deliver real metal, the actual scarcity of silver will be exposed, driving values far beyond current levels. Industrial use, geopolitical uncertainty, and years of underinvestment are colliding with monetary demand to create a once-in-a-generation setup. The smart money is already positioning quietly, recognizing that paper cannot replace metal when confidence breaks. Now, we present the clips from AndySchectman's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
The term that everyone keeps throwing around is the word backwardation. Backwardation is an environment that shows extreme delivery stress. It's unprecedented. This isn't just volatility in my mind. It's the market exposing the shortages of physical silver, the frailty of the paper promises. This is something that I think is just beginning. And there's just far more demand for physical silver than there is the availability. And the paper system is beginning to show great strains. People have accepted paper promises for a very long time. And I think that's coming to an end. And look, this is decisively bullish for silver and other precious metals. But I think it's beginning to show that the paper promises that this whole Western system has been based upon is starting to break. For example, in London, they have a 140 million ounce float, yet they're trading 600 million ounces a day in contracts that technically are deliverable. What could possibly go wrong? There's over 2 billion ounces in paper claims out there on a float of 140 million ounces. So that's exactly what it is. It's a situation where the paper promises, this rehypothecation is being called on the mat. And you can see that. Look, for example, the lease rate in silver in London, when you lease silver in London, it would be something like you want to short a contract. You want to short the price of silver, but you don't have the metal. So you have to borrow metal through leasing it in order to deliver the metal, to drive down the price. Normally that lease rate is somewhere in the neighborhood of 0.5% or 1%. In October, it's jumped up over 39% to over 39%. And at the same time, we've seen silver rise since August when the lease rate was at about 1% or so, up to $53 here. So you see the price rising, the lease rates rising. We're seeing the exact same thing in platinum, but it's a situation where right now you have the spot market trading well above the futures price. In other words, buyers are very desperate for immediate delivery. And it's very rare to see this, Adam, in silver. Yeah. It's very rare. It signals urgent demand, depleted inventories, and really a systemic shortage of deliverable bars. And that's all because of rehypothecation. In other words, it's getting called onto the carpet. in COMEX, adding to the limited vault supplies. But yes, the main stress is in London right now, and much more so than on COMEX. And really, it is, in my mind, the epicenter of where all of this could really get into some serious problems, where you're beginning to see margin calls for traders out there who are receiving a margin call because the price is going against their short position, and the lease rate and the borrowing costs are so high that they're not able to get the silver to cover their position. And that's when things begin to get very, very, very interesting. What it really tells us is that buyers aren't just rolling over their contracts like they used to. They're standing for delivery. They're demanding real metal. And these delivery numbers are well above normal. So I guess if you could encapsulate it easily, it's that the rush for gold and silver is real. It's intensifying. And markets just aren't trading paper contracts right now. The people want the real metal in hand. And in a world where paper contracts are vastly overstating the supply, that becomes a problem. The short-term implication would be liquidations and survival-driven selling can trigger volatility. That's the short term. Even sharp pullbacks. Medium term, as far as I'm concerned, is that once this forced selling ends, the physical scarcity starts to dominate and silver sustains its higher prices, $50 plus. But long term, if confidence in this paper system collapses, like we're seeing, a structural reset could start to reprice silver. That's what I'm seeing. $75, $100. And I say that to you, and that's not pie in the sky, because if you take the 45-year cup and handle that goes like this, the way technical analysis works is the top of the cup 1980, the bottom of the cup the early 90s, and again back up to 2011 again, which is near the top of the cup, and then formed another. It's a double cup and handle. But the way that it works is once silver has broken through 50, which it has, technical analysis would say you take the distance from the bottom of the top, which was $46, from 50 to 4, and you add it to the top. That would mean that the next target from a technical analysis standpoint is $96. And I think that's exactly what you will begin to see, where the market physically begins to exert itself over the paper shenanigans that we've seen for a long, long time. The United States for the last 40, 50 years has bet on a strategy of strong dollar and U.S. bonds and service jobs, where the rest of the world, in particular the BRICS and China, have not been ignoring the factories like we have not been ignoring commodities like we have. China, as a good example, did the opposite. It built factories, accumulated commodities and gold, and now is really pushing away from relying upon the dollar. That is ultimately, I think, where we're going. Yes, exactly that, right there. During the last year and a half, the price has been low, the demand hasn't been very high, and it's only the people like your listeners who understand the importance of owning it. And so the refiners and the dealers and the wholesalers who have been choking on product, they haven't gone out of their way to replenish. And just like that, things change. And I say that all the time, and it's so hard to say this stuff because you get the cynical people out there say, he's talking his book, BS, but I'm not. I've seen it over and over and over again. And so now what happens, you're going to have a lag time, right? You're going to have a big lag time into December where the futures price is well below the spot price, making it very hard for people to even hedge that long exposure. I have done it because I knew that markets repeat themselves. I knew that we were living in a very tenuous environment. So yeah, we have a very good supply of product. But again, when you realize that such a small percentage of the public really has any exposure, that can change very quickly. We've been fortunate enough to have the Sprott brokers run all their business through us, where Rick used to be the CEO. Right. And one of their brokers, or a few of their brokers, have been placing massive orders over the last several days with us, indicative of smart money, I think, realizing that something is broken and things are changing. So it's not just my brokers, it's not just our business. We work with other people like the brokers at Sprott. And I will tell you that the demand at a level of sophistication that you speak to, the people who you speak to, I would say are far more sophisticated than many of the financial advisors that they would work with mainstream, because they understand the big picture, right? You go to a financial advisor who might be the best in the business, but doesn't acknowledge that the world is the way that all of us think it is. the macro picture, the geopolitical picture, which is so very, very important to understand if that's going to be the backbone of advice that you're given on your portfolio. So I guess all I can simply say to you is that most people are going to be caught off guard by this.
Mm-hmm.
And it will go from an environment of high prices that will identify the market to most people, to your people saying, geez, I can't get it easily. It's disappearing. And just like that, it will disappear. So while things are good right now, look, let me put it to you this way. Goldman Sachs said, if the market even suspects for a moment that Fed is losing independence and 5% of the money that's embedded in treasury shifts to gold, the price will go parabolic, will go well north of 5,000. It's going to go well north of 5,000 because Stephen Mirren is the architect of the Mar-a-Lago Accord, and he is now on the Fed. He was Trump's big advisor. Or even this Bo Hines, who was Trump's crypto advisor. He's now running USA Tether, which is backing the Genius Act. There is no independence. The market is going to catch on. The big money is catching on. The rest of the money will too. And then getting product will be very difficult because we've gone a year without any of these wholesalers or refiners or big importers finding much need to go deep into their lines of credit to secure product because there wasn't any need to. I knew there would be. And whether I was stupid or lucky, I'll tell you that there are very few companies out there that have the inventory that we do right now. For the last 5 years in a row, we've had between 1 and 200 million ounces short in supply versus demand in mining with silver. So you have a declining availability of supply. You have an increased demand in silver, not just for its monetary aspect like we're talking about, but it's things like military, it's things like electric vehicles, it's things like solar panels. This plurality in demand is very unusual in the commodity, and silver exemplifies it. So on top of an expansion in demand, you have a decrease. Silver is found in nature like your skin is epidermis. It's found in a form called epithermal right near the surface. The big deposits are declining and disappearing. Only about 20% of the silver mined last year, about 170 million of the 850 million came from mining companies like First Majestic. The rest of it is byproduct of other mining. It's disappearing in nature. So yes, this is a once in a generation, I believe, shift into an asset that has been controlled by the West forever on leveraged futures contracts that is being exploited and understood by the rest of the world. And we're beginning to see it manifest. Now, this may not be that moment, but in my mind, it is moving towards that moment.
The global financial system is entering a significant turning point. The US dollar, once seen as the unquestioned store of value, is now showing signs of profound structural weakness. Confidence in the dollar is fading, and that loss of trust is beginning to drive a decisive shift into hard assets like gold and silver. Behind the scenes, central banks and institutional investors are accumulating metals at historic levels, while the public remains largely unaware. What's unfolding is not simply a rally in commodities, it's a repricing of money itself. As the dollar weakens, commodities rise not because they're going up, but because the currency they're priced in is losing purchasing power. Policies aimed at devaluing the dollar to reshore U.S. manufacturing may accelerate this process, turning metals into the preferred form of wealth preservation. This moment represents both a warning and an opportunity. Wealth is quietly rotating from paper assets into tangible stores of value. Let's get back to the interview.
To me, what this is, it's like the dollar is beginning to be exposed as a unreliable store of value, kind of like a melting ice cube. The trust in the dollar is fading. It's fueling higher commodity prices. This is the dollar devaluation trade. This is exactly what I said on your show, where they're using the Genius Act and the stablecoin bill to not only to fund the treasury market, but think of the $3 trillion that's held up and holed up at the Federal Reserve. Right, all of this money that's been created by the banks that they don't want to lend out into a fractured economy, so they leave it at the Fed. They're going to now pile all of that into treasuries, into the stablecoin bill, the Genius Act, and this is going to devalue the dollar. Keeping your wealth in dollars is the surest way to go broke. This is what they want to do to bring back manufacturing. That is the Mar-a-Lago Accord. They want to devalue the dollar against assets in order to make manufacturing more competitive. And Judy Shelton was just on my show again. Actually, Michelle McCory did it this time. She runs our YouTube channel as well now, and last week. She said it again, that Trump is going to peg the back end of the Treasury market on July 4th next year. It's a big day for him. It's the 250th anniversary. If they back the back end of the Treasury market with gold and let gold slowly, like Luke Groman says, let it go higher, 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 higher. And yeah, there'll be volatility, but it keeps going. And no one acknowledges it. Everyone says, "Oh, it's FOMO or it's going to crash." But what if it's part of a bigger plan? By letting gold go higher, you're not doing it to make my job easier. You're doing it to let the dollar devalue. Why would you want the dollar to value? Ask Stephen Mirren, the architect of the Mar-a-Lago Accord. To sell manufacturing. How do you sell manufacturing? You abandon the reserve status of the dollar. You don't give up on the United States, but you abandon the reserve status on the dollar by letting the dollar collapse. It's down 11% in value already this year and falling as gold is moving in the other direction. If you peg it to the back end of the bond market, and in Judy's book, she says 5, 10, 20, 30, and 50, with 30 and 50 having a very small coupon, very small. But if you do that, you can now bring back manufacturing at zero upfront borrowing costs and sell your product to the world at a massively devalued dollar. This is what they want to do. And so when you see gold and silver going higher, it's not gold and silver going higher. It is the dollar losing ground and losing value. And the big money understands this. The big money understands this inherently. And this is what they have been doing. The central banks understand this. This is why they have been taking positions in gold and silver the way that they have. I think this is just the very beginning. So, yes, you're going to see pullbacks. You will see volatility. Nothing goes straight up. But I would agree with you that ultimately it is a buying opportunity. And I try and say this without coming across as being a snake oil salesman. I don't care if people rush to buy metal from me. That's not what this is about. It's about trying to convey something that I believe in my soul is happening. We have reached a point where being the world reserve currency, even ask Vice President Vance, who has come out and said so, being the reserve currency is no longer a benefit to the United States. It's a detriment. It's a benefit to us consumers. It's a detriment to anyone who produces anything. And in order to continue to move forward as a country, we need to reshore manufacturing. And the only way to do that is in a devalued dollar and at very low upfront borrowing costs. The Genius Act will keep rates low on the front end of the curve and fund the government. The pegging of gold at a much higher price, regardless if they revalue it or not, which I think they will, I think they'll just let it keep on going higher slowly and no one notices it, right? No one is taking action because they're waiting for the other shoe to drop, and it always has. Will it continue? I don't know. Gold's up 55% this year. It's on pace for its best year ever. Silver's up almost 70%. And I do think that commodities will now be a reflection of a declining dollar. It's not that the commodities are going parabolic just because. It's because the dollar needs to be devalued in order to reshore manufacturing. And if there's nobility in what President Trump is trying to do, if I'm reading this right, it is the realization that we cannot continue to be the world's superpower without manufacturing anything, with being reliant on the world for everything. And ask yourself this: if the Congressional Budget Office, has come out and said by 2031, 100% of all tax revenue will go just to pay the interest on the debt, right, and mandatory entitlement, how do we continue to fund our military to rule the world when military spending is discretional? Yes, this is all together. Buying gold and silver right now is not, you're not buying it to get wealthy. You're buying it because it is wealth. And the biggest money in the world, the biggest. It's one thing for me to say the central banks are doing it. It's another thing altogether to say the most sophisticated traders on Wall Street, the institutional traders who are standing for delivery left and right, they know what's coming. And I think that's what you follow. I mean, literally nothing in the way of selling. And we're, for the first time since 2021, we're seeing the average person a little bit more come in. And I must have received 30 emails yesterday. They all said something like, are you out of silver? Are you going to run out of silver? The big money has been buying up gold. To tell you that my cost on a gold buffalo, my cost is north of $200. I've never even dreamt of saying anything like that. That's before I make a penny. The big money has been doing this now for the last 6 months. And, money that is concerned not about making profit, but about protecting what they've worked so hard to obtain. Now you're getting a little bit more anxiety-driven buying, which I don't think is out of line, to be honest with you, because I'm watching how fast our inventory is depleting, and I have a good inventory. But I talk to my suppliers, and the big money in the wholesale market, they're frozen. They don't know what to do. One of my big suppliers yesterday morning sent me an email first thing in the morning and said we're halting trading. We're halting trading because until we get a grip on premiums and on availability. I'm going to read to you a email or a text message that I got from Michelle McCory last night. Now, I haven't been able to validate it myself, okay? But I want to read this to you. I got to turn my phone on. It'll take 1 second. It says Perth Mint suspends silver sales amid global shortage. Australia's Perth Mint halted all silver product sales on October 13th due to surging demand from industrial investment sectors overwhelming supply chains. U.S. dealers like Brian Kuzmark of Commercial Rare Coins and Precious Metals have frozen transactions, citing inability to hedge source product and price premiums, while Indian markets face empty shelves. The Silver Institute projects a 2025 market deficit of over 200 million ounces, pushing spot prices up 4%. So all I can tell you, I don't know if it's true or not, but you're beginning to see things like strain not only in mints and refineries, but also in retail companies, $1 trillion. All-time high for the retail public. At the same time, the insiders are selling between 2 and 4 billion a week since June. And Bezos selling 7 billion in Amazon stock, and Buffett on 500 billion in cash, and all of the institutional traders moving the other direction and standing for delivery on physical metal and COMEX. In other words, the public is all loaded into the equity market. The big money is leaving the equity market and buying copious amounts of silver, more so than we've ever seen, not just the central banks. And what could possibly go wrong, right? Well, so in terms of junk silver, I was able to buy because this guy doesn't hedge his position, and he let it run all the way up. He said, you take it all, I'll sell it to you below spot, which I bought it. There are good values out there still. I don't know how long that lasts for, but you look at the Silver Eagle and it's anything but. You look at every major online company out there, I'll probably be the cheapest on Silver Eagles, but you're not going to find any major company out there that will sell you Silver Eagles in quantity, probably at under $7 an ounce over spot. Just like that, when 3 weeks ago, they would have been sold to you for $4 silver. And things are changing very, very rapidly right now. There's still good deals out there, but I don't know how long that lasts for if this continues. What I said was it's not time to trade your silver for gold yet. There will come a time to do it when the ratio corrects. It's an anomaly where the ratio is. For 5,000 years, the ratio was 16 to 1.
Right.
It's coming out of the ground at 7 to 1. There will come a time to trade your silver into gold. But yeah, I think gold's going to go higher than anyone thinks possible. It is being reintegrated into the monetary system 100%. So, to put all your money into silver, if you're buying precious metals, it is a better value, and it does have an angle. I still think I wouldn't ignore gold. And even though it's gone up high, I think it's going to go much higher. Not straight up, but I really do think it'll go higher than people think. If Judy is right, and if I'm right, and they're going to peg it to the back end of the treasury market, it has to be much, much higher. Luke Groman says they'll let it go to 7,000 or 8,000, and then they'll revalue it from a higher level so as to not have to revalue it from such a low level. Luke Groman is as smart as they get, so I wouldn't discount what he says either.
The era of blind trust in the dollar is fading, replaced by a global awakening to real value. What's happening now isn't just about price movement. It's about the exposure of a fragile system built on leverage, debt, and illusion. As the cracks widen, gold and silver aren't simply rising. They're revealing the truth that paper wealth can no longer hide. Central banks, institutions, and seasoned investors know this. They're not chasing returns. They're protecting purchasing power. The next phase of this cycle won't reward speculation. It will reward preservation. When currencies lose credibility, tangible assets reclaim dominance. This moment is about more than profit. It's about survival in a system resetting itself before our eyes. Share your thoughts on his analysis in the comments section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. Thanks for watching.